When you get a loan, where does that money actually come from? Does the bank take it from someone else's deposit, like the traditional story we were all taught? Or does it simply create new money out of nothing? Let's find out through the experience of two people, Adam, who deposits money, and Maria, who borrows it. First, we'll follow Adam's deposit to see how the traditional story explains money creation. Then, we'll switch to Maria and see how it really works in modern banking. So, let's start with Adam. Adam takes $1,000 in cash to his bank. Now, two simple things are true. The bank has $1,000 more in cash, and it owes Adam $1,000 because he can take it back whenever he wants. So far, no new money, just money moving from Adam's hand into his account. The traditional explanation says banks only need to keep a small part of deposits as a safety cushion to handle payments and cash withdrawals without running out of money. Let's say that cushion is 10%. That means the bank can lend out 90% of Adam's deposit, $900, while keeping $100 as a cushion. Now someone else borrows that $900, spends it, and the money ends up in another bank. That bank keeps 10% and lends out about $810. Then the next bank does the same, and so on. According to the classic view, that chain of lending, spending, and redepositing keeps going. And with a 10% cushion, Adam's original $1,000 can end up as almost $10,000 in total, spread across many different accounts in the banking system. This is called the money multiplier. It's tidy, it's logical, but it's not how banks actually operate today. To see how they really operate, we'll follow Maria. But before that, a quick note. In modern banking, it's useful to think of two layers of money. First, central bank money is the cash in people's hands and in banks' vaults, plus the balances in banks' own accounts at the central bank. Together, that vault cash and those central bank balances are what we will call the bank's reserves. Second, bank deposit money is the money you see in bank accounts, your balance, Adam's balance, and everyone else's balance. That money can come from different sources: cash people put into the bank, transfers they receive, and later in our story, loans. With that in mind, let's see what happens when Maria takes out a loan. Maria wants to start a small studio and needs $500 to buy equipment. To get that money, she applies for a loan from her bank. In the traditional story, the bank is supposed to first collect deposits from people like Adam and then lend part of that money out. But in reality, it doesn't work like that. Here's what happens instead. When Maria's loan is approved, two things appear at the same time in the bank's computer, its system. The bank writes, "We must pay Maria $500 right now." The bank also writes, "Maria will pay us back $500 in the future." In other words, Maria and her bank agree that they both owe each other the same amount, $500. But there's an important difference. The bank's promise is on demand. Maria can use that $500 straight away. Maria's promise is later. She has to repay in the future. Because of that timing difference and the risk she might not pay at all, Maria has to pay interest. And here's the key point. The $500 in Maria's account did not exist before the bank approved the loan. It appeared at the moment those two promises between Maria and the bank were created. No one else's balance went down. No physical cash moved. A simple agreement between Maria and her bank turned into money she can spend. That's what people mean when they say, banks create money when they make loans. Now this brand new $500 is sitting in Maria's account. What happens when she actually spends it by paying her supplier? As we follow that $500, we'll see how it moves through the system and why money created this way doesn't stay around forever. First, we look at three simple spending cases. Case 1. The supplier uses the same bank as Maria. In this case, when Maria pays her supplier, Maria's balance goes down by $500. The supplier's balance goes up by $500. The total amount the bank owes its customers does not change. It just no longer owes Maria. It now owes the supplier instead. In other words, the $500 is still digital bank deposit money, still in the system. It just moved from Maria's name to the supplier's. Case 2. The supplier uses a different bank. Now, Maria makes the same $500 payment. Maria's balance at her bank goes down by $500. Her bank now has to send $500 of its own money, the money it keeps in its account at the central bank, its reserves, to the supplier's bank. The supplier's balance at their bank goes up by $500. Again, Maria's bank no longer owes Maria anything, but this time, it also had to give up $500 of its own central bank money to complete the payment with the supplier's bank. Case 3. Cash only. Here, Maria doesn't pay by transfer at all. She goes to the ATM, withdraws $500 in cash, and hands that cash directly to the supplier. Maria's balance at the bank goes down by $500. The bank hands her $500 of its own cash from its vault, its central bank money. From the bank's point of view, this is very similar to Case 2. It loses $500 of its own central bank money, and it no longer owes Maria anything. That $500 of cash is now out in the economy in people's hands rather than sitting in the bank's vault. In all three cases, one thing is the same. The bank's promise to Maria, her balance, disappears once she spends or withdraws it, while Maria's promise to the bank, the loan, is still there. But that raises another question. What happens when Maria starts paying the loan back? And how does that loan-created $500 finally leave the system? To answer that, we'll now follow Maria as she repays her loan. To keep it simple, we'll assume she repays the full $500 in one go and will ignore interest. That doesn't change the core logic of how bank-created money appears and then disappears from the system. We'll walk through the same three simple situations as before, this time to see how Maria's repayment works. Case 1. A client who has an account at the same bank as Maria transfers $500 for Maria's work. Maria's balance goes up by $500. Maria then uses that $500 to repay her loan. Therefore, the bank reduces what it owes Maria, her balance, by $500 and sets what Maria owes the bank, her loan, to $0. That $500 deposit in Maria's name, the money she just received from her client, is deleted at the moment of repayment. So, there is now $500 less bank-created digital money in Maria's account, and therefore in the banking system overall. Case 2. A client who has an account at another bank pays Maria $500. First, the other bank cuts the client's balance by $500. It sends $500 of its own money at the central bank, its reserves, to Maria's bank. Maria's bank increases Maria's balance by $500. So far, the client's balance at the other bank went down $500. Maria's balance went up $500 at her bank. The total amount of deposits in the system is still the same. Then Maria repays her loan. So, her bank reduces what it owes Maria, her balance, by $500, sets what Maria owes the bank, her loan, to $0. Here, the $500 deposit in Maria's account is deleted when she repays. The $500 of central bank money, the reserve sent by the other bank, stays at Maria's bank and can be used later to settle other payments. In the end, there is $500 less bank-created digital money in the banking system. The total amount of central bank money, cash plus reserves, has not changed. It has just moved from one bank to another. Case 3. In this case, Maria walks into her bank and hands over $500 in banknotes. The bank's cash on hand goes up by $500. The bank sets what Maria owes the bank to $0. Now, Maria no longer owes the bank anything, and there is $500 less cash in Maria's hands, and therefore in the public's hands overall. That $500 now sits in the bank's vault, not in anyone's pocket or account. In all three cases, the same thing is happening in the background. Maria's loan is paid off, and the extra money that loan created in the first place disappears from the economy. That's how this works. In simple terms, Loans create new money on the way in, and repayment destroys it on the way out. This leads to one more question. If banks can make and delete money this way, what stops them from creating money without limit? In the real world, 4 things hold them back. First, people only borrow so much. Adam, Maria, and everyone else usually take loans when they need the money and when they think they can pay it back on time, with interest. If nobody wants an extra mortgage, car loan, or business loan, the bank can't just push new money into their accounts. But even when people do want to borrow, the bank has to think about the risk of not getting paid back. Every loan is a bet. If Maria's business fails and she can't repay, the bank takes a hit in one way or another. Even if it seizes collateral, it still has to sell it, may lose money, and it ties up time and resources. If it makes too many bad bets, it can go bankrupt. So, banks keep asking, if we create this new money as a loan, how likely is it that we'll get it back? When those first 2 things look good, the bank has to ensure it doesn't break any rules from regulators. Banks don't get to do whatever they want. Regulators and central banks require them to hold enough safety buffers, for example, a minimum amount of their own money, called capital, and enough cash and reserves to handle payments and withdrawals. If a bank tries to grow its loans too fast, it quickly runs into these regulatory limits. Meeting all the rules is one thing, but what ultimately keeps a bank running is trust and reputation. Banks live on trust. If they lend recklessly, investors, customers, and other banks start to worry. Will this bank survive the next crisis? When that trust is damaged, funding dries up, customers move their deposits, and the bank can't keep expanding its loans. So yes, banks can create money when they make loans, but they cannot do it for free or without limits. For every new dollar they create as a loan, they have to consider all 4 of these factors: demand, risk, rules, and trust. Together, those decide how far money creation can really go. Let's tie it all together. Adam's deposit simply moved existing cash into the bank. The traditional multiplier story tried to explain how banks could expand that money, but it's really just a simplified story. In today's world, when Maria took a loan, the bank created new money. When she spent it, that money began circulating through the economy. And when she repaid the loan, that same money was destroyed. Behind it all stands the central bank, setting the rules, supplying the underlying central bank money, and maintaining trust in the system. So yes, banks really do create money from nothing, but it's not magic. It's a system built on promises that can be created, spent, and then destroyed, all within real-world limits. So, that's where we'll leave it for now. If this helped you see money and banks a little differently, that was the whole point. For a quick recap of the main ideas, check out the summary video linked in the description. We'll keep exploring questions like this in future videos.